Right now, SoFi Technologies, trading under the ticker SoFi, is priced at $26.33, down about 0.34% in today's trading session. The stock opened higher and even touched $27.33 before pulling back, showing us a classic intraday tug-of-war between buyers and sellers. And while most of the chatter you'll hear on this name revolves around its profitability timeline and the ever-present student loan debate, the market seems to be missing the most critical part of the story. The popular expectation is that SoFi is a fintech lender, a digital bank. But the reality, the detail that sophisticated investors using platforms from Fidelity Investments to interactive brokers are closely watching, is that SoFi is quietly building an enterprise-grade technology backbone that could one day dwarf its consumer-facing business. The market sees a bank, but the smarter players see an infrastructure company, a fintech Amazon Web Services in the making. And that disconnect is where the real opportunity lies. The common belief about SoFi is that its fate is directly tied to interest rates and the ebb and flow of its lending business. The narrative suggests that, as a lender, particularly in personal and student loans, it's highly sensitive to economic cycles. When rates are high, the cost of capital goes up and loan demand can soften. When the economy looks shaky, credit quality becomes a concern. This paints a picture of a company perpetually at the mercy of the Federal Reserve's next move, a high beta stock that's a great ride in a bull market, but a painful holding in a downturn. This is the simple story, the one that's easy to digest for someone quickly glancing at their Robinhood app between meetings. But this expectation falls dramatically short of the underlying reality. The truth is, SoFi's business is a three-legged stool, and the market is almost entirely focused on just one of those legs. While the lending segment generates the majority of current revenue, the fastest-growing and arguably most valuable part of the company is its technology platform, powered by Galileo and Technisys. This segment provides the core digital banking and payment infrastructure for a huge number of other fintech companies, neobanks, and even established financial institutions. This isn't a cyclical lending operation. It's a recurring, high-margin, business-to-business technology service. It's the picks and shovels play in the fintech gold rush. So while the market obsesses over loan origination volumes, the real metric to watch might be the growth in technology platform accounts, which tells a far more compelling story about long-term sustainable growth, much like how investors track cloud consumption for tech giants rather than just iPhone sales for Apple stock. Looking at the recent stock movement, this tension is palpable. On days when macroeconomic fears dominate, SoFi stock often trades in lockstep with other neobanks and lenders, getting pulled down by sector-wide anxiety. We've seen significant trading volume on these down days, suggesting that short-term traders and algorithms are playing the simple, fintech lender narrative. However, following these dips, we've also observed periods of accumulation, where the volume on up days is strong and the price finds support at key technical levels. This could indicate that institutional buyers, perhaps executing trades through Fidelity Brokerage or other major desks, are using these moments of weakness to build positions, recognizing the long-term value of the technology platform that the retail market is overlooking. The daily swings have been pronounced. In the last month alone, we've seen the stock test both its upper and lower Bollinger Bands, signaling heightened volatility. The reaction to its last earnings report was a prime example of this dynamic. The headline numbers for loan originations were solid, meeting expectations. But the real surprise was the accelerated growth in the technology platform client base and the upward revision of its full-year guidance for that segment. Initially, the stock popped, but as the broader market sold off, SoFi gave back some of those gains, showing how it remains shackled to the market's simplistic perception of the company. This is a critical factor for anyone considering an investment. You have to be willing to tolerate the market's short-term misunderstanding of the company's fundamental structure. A self-investing individual must look beyond the surface-level comparisons to other consumer finance apps. So what does SoFi actually do? It operates through three distinct segments. First is lending, the one everyone knows. This includes student loan refinancing, personal loans, and home mortgages. This is their customer acquisition engine, drawing people into the ecosystem with major financial products. Second is the financial services segment, which is their attempt to become a one-stop shop for their members' financial lives. This includes SoFi Money, a cash management account, SoFi Invest for trading stocks and ETFs, SoFi Credit Card, and more. The goal here is the flywheel effect. Acquire a customer for a student loan, then cross-sell them into a SoFi Invest account, then a credit card, and so on, dramatically lowering the lifetime cost of customer acquisition compared to a traditional bank. This is where offerings like SoFi Investing directly compete with platforms like the Robinhood stock trading app. The third, and as I've argued, most crucial segment is the technology platform. Through its acquisitions of Galileo and Technisys, SoFi provides the back-end infrastructure that powers many other fintech apps. If you've used a neobank or a trading app, there's a decent chance Galileo's APIs were processing your transactions. This B2B segment gives SoFi incredible diversification and a footprint across the entire fintech landscape, generating steady, recurring revenue streams that are not dependent on SoFi's own lending volumes. This three-pronged approach is what separates it from monoline fintech players and is central to the bull thesis. Looking ahead, the future outlook presents a fascinating divergence of possibilities, all framed by this expectation versus reality dynamic. The most immediate catalyst is the full maturation of its bank charter. By holding its own loans on its balance sheet and funding them with low-cost deposits from its SoFi Money product, the company can significantly improve its net interest margin and profitability. The expectation is that this will make their lending arm more profitable. The deeper reality is that it de-risks the entire business model, reducing its reliance on selling loans in the volatile capital markets and providing a stable, low-cost source of funding to fuel growth across all segments. This is a structural advantage that many of its non-bank fintech peers simply do not have. Another major point of focus is the growth of the technology platform. The integration of Technisys with Galileo allows SoFi to offer a complete end-to-end core banking platform for its enterprise clients, a hugely valuable proposition. If they can successfully cross-sell this integrated solution and land more major clients, the market will be forced to re-evaluate SoFi as a technology company, potentially leading to a significant re-rating of its valuation multiple, moving it closer to a tech stock like Nvidia stock rather than a traditional bank. Now, for the risks. The biggest risk remains execution. Building an all-in-one financial super app and a dominant B2B infrastructure provider at the same time is incredibly ambitious. A failure to effectively integrate these parts or a slowdown in innovation could leave them vulnerable. Competition is also fierce, not just from fintechs, but from incumbent giants like JP Chase, who are pouring billions into their own digital offerings. And of course, the macroeconomic backdrop remains a headwind. A severe recession would impact loan performance and could slow down growth. Comment below with which SoFi product you think is their most important for long-term growth: lending, financial services, or the technology platform. In conclusion, the story of SoFi Technologies is a textbook case of market expectation versus a more complex operational reality. The prevailing market view sees a digital lender, a company whose fortunes will rise and fall with the credit cycle. This view is not wrong, but it is profoundly incomplete. It anchors the stock's performance to a single volatile segment while largely ignoring the powerful scalable technology engine being built under the hood. The reality is that SoFi is a hybrid, a consumer-facing financial ecosystem built on top of an enterprise-grade technology platform. The path forward for the stock will be determined by how and when the market closes this perception gap. The daily price action will continue to be noisy, driven by headlines about interest rates and loan demand. But the long-term value creation will likely come from the sticky, recurring revenue of its technology clients and the powerful synergy of its integrated business model. For the investor willing to look past the simple narrative and analyze the underlying machinery, SoFi presents a compelling, albeit complex, opportunity. The real test is whether the company's B2B technology reality can ultimately break free from its B2C lending expectation.